Hello and welcome to a very special episode of BNSN on campus. I'm at the sprawling facility of the SP Jain School of Global Management in Singapore. This 5,000-member graduate community was established in 2005 and they have campuses across Dubai, Sydney and Mumbai. Some of the programs such as the Global MBA, the Masters of Global Business and Bachelor of Business Administration have been ranked by Forbes, The Economist and Nielsen. Well, let's get straight to the classroom because we're getting lessons from a very special market guest. So we're here in the classroom at the SP Jain School of Global Management in Singapore, interacting with students of MGB and GMBA. With us on the program, we have none other than Samir Arora, Fund Manager, Helios Capital, on the show. Thanks so much, Samir, for being with us. I want to start off by talking about the basics of investing. You had said in one of your articles earlier that it's important to invest in installments. That's a strategy that you'd like to adopt. Any other pearls of wisdom for first-time investors such as these students?
Before that, the bigger issue is whether asset allocation should be in equities or fixed income, and that is a bigger event than whether you are investing in a monthly fashion or not. And I think because I am a product of the equity markets, there's a lot of evidence, 200 years of US markets, 100 years for 16 countries, that over time, equity does better than fixed income by about 5% per annum. And at the end of the day, we have seen that the maximum money is made for an individual by his asset allocation rather than that whether that equity then when he invested, how much it outperformed. And in India, I think the allocations are very, very low. But when we say allocate sort of in a systematic way, is just to get over this fear of his that he's coming in at a wrong time, he's coming at a peak. Actually, I would say invest because I'm a bullish guy. But generally, this is just a bit of marketing. What
kind of a student were you, Samir? A backbencher or did you sit right in front?
No, I was a backbencher, but I was a gold medalist at IIM Calcutta.
That's why you're sitting here today. Okay, let's talk about why you're so bullish on the India story. Would it be the monsoon factor, GST? Do you think that some of the global concerns would perhaps be a bit of a dampener?
No, but before that, big picture first, equity itself being bullish has been right. Not for India, but for everywhere. So that is a starting point. Second, just to give you one statistic, since 1995 December, I started in 94, you can say, from actually managing money. But from 95 December to now, in US dollar terms, at least till 31st December, and I think this year maybe also included, India in dollar terms, the index, and not fund managers who've beaten the index, has beaten Berkshire Hathaway in dollar terms. So anybody would have felt very lucky, oh, I was invested in Warren Buffett's vehicle in the last 10, 15, 20 years, but our unmanaged index has beaten that. Today, if you're talking about GST and all, that is more, you can say, immediate term. In immediate term, the biggest is monsoon, yes, and then maybe GST. But we are talking in a big picture sense that India has done very well in the past, and now you are at the start of a cycle, interest rates are still high, the world has less choices, and so we are in a slightly better spot than normal because of lack of growth in other markets. But in the short term, both GST and monsoon has already happened, are pretty crucial.
Yep, so the proof is in the pudding when it comes to the numbers. Let's throw it open then to our students and get some questions for Samir to answer. Would anyone like to start off from that side?
Hello sir, my name is Akash. I'm doing a market research on how the interdependencies of the global stock markets affect one market and how events like shake up the market. So my question to you is that in the past also we have seen that events trigger speculation, and because of that markets, even though fundamentally being strong, they get affected to a certain level that they start factoring in way before. So up till what extent and how much time does it actually take for a market to come back to its fundamentals?
There is no such thing. The fundamentals can stay, or the unrealistic market can stay up beyond your bankruptcy. That's what they say. Markets can stay irrational longer than your ability to hold. But in a longer term sense, markets rely on fundamentals, but these days, for the last maybe 5, 10, 15 years, the globalization of markets means that the same end investor is going into all these markets. So in 2008, and therefore if he does badly in some market, and they have redemptions, that affects other markets. If you look at 2008, India did not have a banking crisis, but Indian stocks, banking stocks fell more than many US and global stocks. It's not that we were fundamentally good. So it is a mixture, and that's why these days it's become more difficult, because it is not only your own country's fundamental, because the flows are from global, export, import is global, and generally the contagion is very fast. So this question cannot be easily answered. The bottom line is that a crisis in other markets is good. A weakness in other markets is good for you, but a crisis in other markets you can't celebrate. Just like we cannot celebrate that oil, if it's down from 100 to 80, very good, 80 to 60, very good, 60 to 20, not good, even for us who are importing oil, because it reflects other issues which are also to be accounted for, rather than just saying that because we import oil, lower oil is great. Same thing with the markets. We want other markets to be bad compared to us, but not very bad.
Samir, I want to just take off on that question. What do you think as an event or a big risk from the global markets would be the next thing for us to watch out for?
Well, generally we have failed in predicting the next events because they start with such small issues. You know that World War I started with some assassination of one fellow, and the US government, or I think maybe all of them together, they made a committee to find out why World War I happened. And they still haven't figured it out, that what was the reason for such a big event to have happened. So if you look at our markets, in 2008 was different, then it was Europe. Today I would say, because something we have to believe up to a point, is that when UK actually starts negotiating the exit, then the European Union has to make it difficult for them. Because if they make it easy for them, then other countries can get encouraged or feel that, you know, it's not such a bad deal. That time these things will again come up. Right now, you say it's 2 years later, so don't bother me. But just today, if you read in the papers, Ford says that they're going to lose $1 billion because of Brexit. Because they'll have to close some plants, open some plants, whatever. So these things we don't know. But when it happens at that time, you normally are surprised because you start believing that it's not happening.
Yeah, so Brexit is going to be a big event to watch out for. We've got another question from this gentleman here. Go ahead.
Hello, I'm Akshay Desai. I'm doing my GMBA from SP Jain. My question is more about the personal investment portfolios. So there is always a classic debate between the investment in a real estate as compared to investment in mutual funds. So if you could throw some more light about the...
I think there is no debate. If you have black money, you should invest in real estate.
How much black money do you have, Samir?
In Singapore, there is no black money in real estate.
That's why you're here.
Indian real estate, I meant, sorry. Indian real estate. Indian real estate is like you can check in, but you cannot check out. Because when you sell also, they'll give you some money and then you'll have to reinvest it in another one. There's no comparison. Also, it's a matter of size. If your initial investment, first of all, for your own living, real estate is the best investment. But we are talking, that is not investment. But beyond that, I don't think there's any comparison because of the difficulty of investing, the cost of investing, and the transaction size.
And young lady here has a question for you, Samir.
Hello, sir. This is Shrishti. Does portfolio churning creates a big challenge in fund management? If it does, how far it can be controlled?
Because the portfolio manager does the churning so he can control himself. You mean the investor coming in and out? Well, I don't invest. I mean, I'm not a mutual fund manager anymore. So my guys don't churn. But in general, when you are large, and if you keep 1 or 2% cash, normally it takes care of most of the things. So the portfolio manager, whether he churns or not, is his own wish, whether he believes in the market, he believes short term or long term. These days, there are no taxes on mutual funds in India, so they can churn actually if they so desire. Generally, the churn is unhelpful when you are doing on your own, because every stock you sell and then buy something else, you would have triggered a short-term capital gain, but not in a mutual fund. So there they will not do it because churning, people have found, does not, because you're too much short-term, and too much short-term has not helped. But if somebody thought it is so, they can do it. It won't change somebody else's life.
Great, Samir. We'll take a quick break then on that note, but we'll come right back. Ask Samir who his guru or teacher is that he looks up to in the markets, and all that and more coming right back on BNSN on campus at SB Jain Global in Singapore. Welcome back. We are tuned into Buy Now, Sell Now on campus, and we're at SB Jain School of Global Management in Singapore in conversation with Samir Arora, Fund Manager at Helios Capital. The classroom is abuzz with lots of questions for you, Samir, but I want to ask you, who's a person when you were younger that you looked up to when it came to advice for the stock markets?
You know, I read a lot of books, and first thing is that everybody who wants to be in this business or actually anywhere in life has to read. If you don't read, you are less impressive as far as I am concerned. So, you know, in the 90s when I started, and even now everybody starts by reading Warren Buffett's letters or books on him and things like that. And over time, I read everybody's thing, and it's sort of an absorption of various views.
Anyone that stood out?
No, but that, Mr. Buffett only stands out. There's no need. But, you know, because I become a hedge fund manager, so I also read about the new hedge fund managers there, Soros's books. There are many, many, many books, and I would have read whatever I could read, and I still read a lot. So I won't say any one guy in that sense, but overall reading has helped a lot. So I would say books are my biggest guru.
Okay, I hope you guys took note of that as well.
Very important.
Yep, a question from the back.
Hello, sir. This is Shankdeep. We recently discussed about the impact of Brexit. Another important event which I see, and I think everyone sees, which will be important, is the US elections. So how do you think the winning of the Democrats or the Republicans will impact the market in short term and long term?
Well, I am confused who will win, but I think Donald Trump will win.
Seriously?
Because that is the trend these days. That is the trend that you are going.
Don't say that, really.
Yeah, but you know, it's not clear that what will happen. When I look at companies where there's been a change of CEO, whenever a high-profile CEO has come, in this case, we will not consider Donald Trump as high-profile, or as in is an unexpected in that sense, or different from the high-profile guys disappoint, or a guy who you never thought will do well because in that context you didn't know him, and in this context you don't believe him. So I think it'll be confusing. Because both these guys will moderate their views when they actually win. Right now, because we do only India, we say that we don't preempt global events, but we react to them by shorting or whatever. But for me to preempt that, I don't. So I don't overly think about that impact on the market because I don't know exactly which policy they will influence. But in a big picture sense, if Donald Trump came, maybe there'll be more investments in defense, maybe there'll be, you know, more aggressive negotiations with pharma companies and others because they say that they want to bring down healthcare costs. And in US, under some rule, the government, which is the biggest buyer, cannot negotiate with pharma companies. Obviously, it must have been some, you know, basically a or not bailout, but helping some pharma companies in the past. Beyond a point, we find that these things don't matter except in the first few months. But I think it's pretty competitive. It's not one way.
Samir, I want to ask a question that I'm sure is on everyone else's lips. I mean, sectors you're bullish on, private banks, microfinance, NBFCs. Is there anything else that you would advise?
Can you tell me in the last 6 months, was there anything else needed except having, you know, so our big picture is that we want the company to have a very large potential market. Right now, the biggest potential market is in private sector bank because they are going to take over the market share of state-owned banks. They're going to eat the lunch of state-owned banks, not only because state-owned banks don't have capital and they don't have management, but also because of all the new things of digitalization and internet banking and online in that, and the state-owned banks are nowhere. Maybe State Bank little bit is there, but not the other banks. So that is a very big market. The other big market was MFI, but those stocks have gone up like mad.
The SKSs
so
of the world.
I cannot comment on them now because I may have done some trades here or there. But generally, these stocks are up 30 to 40% in 1 month. And we had, or had, whatever, something, we had a large position, have a large position still. So in a sense, where the large potential is there, you can in your mind still believe that growth rate will be there for a long time. In markets where already maturity has reached, you know that they will only grow at India's growth or things like that. So for example, we think telecom is not only over penetrated in India, but now you have the entry of Big Daddy. So yeah, so that would be on the other side.
Okay, let's get another question from a backbencher who's perhaps another gold medalist in the offing. Go for it.
Hello, Samir. My question is, my name is Sumant, by the way. My question is, there's been a debate about the technical and fundamental analysis among the investors. Which of the two do you think is a better indicator for long-term success?
We have no debate because we only do fundamental. And actually, if you look at all the guys who've done well, other than a few hedge funds, and that also maybe one or two, it's always in fundamental. You look at anybody, because all the guys who have done well in US are the concentrated guys, mostly the guys who buy, very concentrated amount. They can't do technical because they buy 15 stocks and they have to hold them. The activist guys who try to change management, change strategy. The technical guy, okay, now let's look logically. The fundamental guy needs to work in a job because if he's starting out with 100,000 rupees, the company won't meet him, he won't be able to subscribe to data, he won't be able to travel. The technical guy doesn't need anybody, he needs one software. So show me a self-made billionaire technical guy just sitting at home and doing ting, 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 nothing. So there is no debate.
Do we have our self-made fundamental billionaire here?
So fundamental is different. But technical, billionaire in which currency? In some currency. But technical, no. Technical, I don't think there's any debate.
Okay, what about you? What's the question for Samir?
Hi sir, I'm Rijul. So I wanted to know that in the last 2 decades we've had our shares of highs and troughs and recessions. So we've seen the internet bubble and the housing bubble, and the next thing that they speculate is the startup bubble because billions of dollars are being pumped into companies that barely have a revenue model. So how do you think that would pan out in the near future, and what would be the ramifications of it?
I'm so glad you asked this because I know you're not big on it.
I'm the biggest bear on the
know.
If you've been following me, India is a complete bubble, but that bubble has half burst. But I don't think it matters to the market because fortunately it's contained in private equity right now. It hasn't gone public. But the jobs and all, in the new jobs have all been in that sector. Because the thing is, after IT, we've not had a massive big sector where lots of jobs are created, high paying or middle class paying. Like tourism, if it's not there in India, but if it was, it will be a slightly lower this thing. So that is the sad part, if at all. But the fact that everybody, because the thing is, unlike in US, in India, they are not willing to do something which takes 5 years. They want to deliver food to you or dosa to you in a 3-wheeler. And so I don't call that innovation. I have another point that if everybody says I'm helping the consumer, that means I will give you food quickly, somebody else will buy you groceries, the third guy will deliver you some product at a 10% discount. Who are you? Because all these guys are helping you and they are having all the jobs. But the customer of these guys, there's no new customer in the sense, there's no new job outside these sectors trying to help you basically deliver you food and things like that.
Let's get a list, 3 do's and don'ts when investing in the stock market or anything that comes to mind.
When investing in the stock market.
Or just,
First of all, invest in the stock market.
Is a do.
Second is gradually, because anyway the money for young people will be made gradually. And as I said, believe in it. Because also one more thing. Although equity markets have done very well, if you say point to point, I don't think a single investor has made that much money because in between came 2008. Now in 2008, you did not sell on 31st December of 7. You sold in October of 8. By that time, you couldn't take it anymore. And from next month, it went up and you didn't buy it back because you didn't believe it. And so you went to March or maybe May. So by that time, 30% is gone, so the whole return is gone. So that is, by the way, the US and Warren Buffett, why he's better than our market is. If the market or the fund manager doesn't give you that much downside, you have a higher probability of staying with him.
And I think another would be do your homework.
Do your homework if you can.
A good do.
Otherwise, give it to good fund managers.
Yes. Yeah.
In India, you can give mutual fund, all of them well. But broadly, I think that for investing on your own, you have to be interested in the business, not in the business of making money. But just because you like reading about companies and things like that, it's not a...
Believe the
in the
business
beginning
you
is
buy
more of
into?
an interest thing rather than that suddenly you'll.
Okay, and our last question right up front.
Hi, my name is Mohammad Nafis. I have a basic question about portfolio management, which the young investor always are confused about. So when you are starting investing, what do you suggest about the portfolio mix versus debt versus equity, based on the risk appetite, based on the age factor of that particular individual?
So, because I don't do all these things, but the theory is 100 minus age is equity. That is what they say. It's an actual formula out there from financial planning guys. For me, I would say it should be 100% equity in the beginning. How does it matter? Because the amounts will be small, and if it doesn't work, just by next month or after 6 months not putting, you can moderate it. It's not going to, it's not that you've already taken a large amount and banged it in. But in general, the formula is 60-70% for younger people because they'll be 25-30 kind of age group. It's your own this thing on handling volatility. Also, how much are you putting relative to how much you are making every month? Because is that going to be the main driver of your feeling good or bad in life? Or is it that your job is good and you can handle the volatility of having invested 7-8% or 10% into equity? But broadly speaking, as I said, in big picture terms, equities do better. Now, some people choose not to do that because they are paranoid. So they will invest less. That's the only thing.
So on that bullish note, Samir, thank you so
very
much for joining in. And with that, we wrap it up right here on the show. Thanks for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.